Welcome back. And today we are going to discuss what is the difference between a revenue receipt and a capital receipt. Since the taxation of both a revenue receipt and a capital receipt is totally different under income tax law, and it is same for all other income tax laws as well. It is the general principle, a first principle of economics of taxation or principles of taxation that we do not tax capital receipts unless they are specifically included in the definition of income. And we always tax revenue receipts unless they are specifically exempt. So, how do we identify whether a receipt is capital or is it revenue in nature? It is a very landmark case law in Indian history, that is CIT versus Shaw Wallace and Co., which was decided in 1932, if I'm not wrong, where the Privy Council back then determined that the capital receipts are not in the purview of the Income Tax Act. And to tax these capital receipts, you have to bring them into the definition of income. And it determined in a manner that how do you differentiate between a revenue receipt, which is to be taxed, and how do you differentiate it with a capital receipt, which is not to be taxed. It gave us three important characteristics. First is that a income should arise from a definite source. The source has to be there. Then it should be in a form of periodical returns, a definite return. It should have a periodicity. If not really periodic, it should have an expected periodicity. So windfall items like lottery incomes and these other horse race, gambling incomes, these are windfall items. There is no periodicity. So in that case, these were out of the purview, and slowly the taxmen, the Indian authorities or the global authorities, they really started to tax these items as specific incomes. They started including these capital receipts into your total income scope. This case law is very important. We need to understand that how do you decide whether it's a capital receipt or whether it's a revenue receipt is important to understand the taxability of certain items. In the next two videos, I'm going to discuss a domestic matter of how alimony is taxed, which will have its links to all this concept of periodicity, source, and a defined rate of return. And another international matter of how, without a permanent establishment, a non-compete fee is not taxable. Stay tuned.